Okay, so each of these three ETF portfolios that I've shared look very simple. Each one has only 5 ETFs, but it's deceptively simple, as I say. The portfolios themselves have thousands of stocks, more than 30 countries, and about a dozen currencies. And it's rounded out by government and corporate bonds of all maturities. There are hundreds of bonds in those three ETFs. And so what you've seen here is a portfolio for a cost of about 0.15%, they're all in about the same range, is about as broadly diversified as you're going to get. And I would argue is a more broadly diversified, better designed portfolio than probably 90% of Canadians are using today at extremely low cost. So yes, it's simple, but it's also very effective. All right, so now we get into the more technical part, which is purchasing those ETFs. So once you've designed your ETF portfolio, maybe you've decided you want to use a model portfolio that you found on a website, whether it's mine or Justin's or another one. Now you've actually got to go and implement that. So the first step, of course, is opening a discount brokerage account. I don't want to spend a lot of time on this because I don't think it's as important of a decision as many people think. I've worked with all of the big bank brokerages as well as some of the smaller independent ones. They all have strengths and weaknesses. And I think that the big bank brokerages now all have pretty similar options. They certainly vary in a couple of different ways, not necessarily very important ones. So I often say to people when they ask me to recommend a brokerage, I say at least start by looking at the one associated with your bank. I think that's often the best place to start. It isn't necessarily going to be the best brokerage for you, but it's a good option to start. There's certainly some convenience in integrating your banking and investing, so it's a good place to look. In any case, all of the major brokerages now offer trades for about $10 or less. Some of the independent brokerages are even less than that, but the big ones this is a typical range, sort of $8 to $10. And a few even often commission-free ETFs. Questrade and Virtual Brokers, for example, some of the independent brokerages have commission-free ETF deals, which are very attractive to smaller investors who don't want to spend a lot of money on transaction fees. I think some of these brokerages may have other features that may not be as positive, but that's at least an interesting offer for people who are looking for rock bottom costs. The real important thing, though, is make sure you're not paying annual account fees. Most of the brokerages have annual fees if your balance is under a certain amount. That is usually under $15,000 to $20,000 per account. Sometimes it's all household accounts taken together. So make sure before you sign up with any brokerage that you do pay some attention to that if you have a relatively small account. If you're investing $100,000, it's not going to be an issue anywhere, but if you're investing a smaller amount, definitely pay some attention to that. You don't want to be using low-cost ETFs and then paying $100 a year for an RSP administration fee, for example. Okay, so the first thing we're going to talk about today is how to read a quote. All right, this is going to be new to a lot of people. If you are interested or have experienced trading stocks in the past, this will be pretty easy for you. But if all you've done in the past is invested with mutual funds or through an advisor and have never invested online on your own, this is going to take a little while to get used to. So I want to give you, this is just a sample quote from a brokerage. And you'll see there's a lot of numbers here, but I want to zero in on the couple that are most important. So the first one I want you to look at is the bid price, okay? So the bid price is the price that you will receive when you're selling shares of your ETF, okay? So what I've done here is just taken VCN, the Vanguard FTSE Canada. This is the Canadian Equity ETF in the portfolio I showed you. We get a quote for it by typing in that ticker VCN into the brokerage, request a quote, these numbers come up. Okay, so you see the bid price there is $28.65, okay? And right beside it, you'll see there's the ask price, and it's $28.67. Now the ask price is the price you'll get, or rather the price you will pay when you're buying shares, okay? So the key thing here is to understand that the price that you're going to pay when you buy is always going to be higher than the price you receive when you sell. And the difference between those two prices, 28.65 and 28.67, is called the bid-ask spread, okay? And that spread represents the profit to the market makers and to the brokerage, okay? So the wider it is, the more expensive it is for you to transact. Ideally, you want to see that spread 1 cent, 2 cents. With many well-traded large ETFs, it is. Sometimes, however, you will see that spread 4, 5, 6 cents, sometimes even more than that. That's a little bit of a concern, and it's just something to be aware of, that if you're trading too frequently, that can be expensive, okay? So the bid and the ask are the two most important numbers here to worry about. One thing that's very deceptive on a quote is what is called the last price. You'll see, I'll flip back here, the 29.78 up there beside the green arrow in the quote is actually the most prominent price in that quote. It's bigger, the font is bigger than the bid and the ask, but I want you to ignore that number. It's pretty meaningless. What that is the price of the most recent trade. Okay, but that doesn't really make any difference to us, because especially with some ETFs that are not traded very frequently, that last price could be very stale. I mean, in some cases, if you're making a trade in the morning, that might be yesterday's price. So please ignore it completely, focus only on the bid and the ask, and don't worry about that last price. It's just a distraction. Okay, the next thing to be aware of are the sizes available. So you see there's a size for the bid and a size for the ask. Okay, by size, they mean these are the number of shares that are available at the quoted price. So let's say, for example, you have 2,000 shares of VCN and you want to sell them. Well, if you look here, our bid price is $28.65, and that's what we would expect to receive when we sell our shares. But the size is only 1,100 shares. So what that means is, if you were to sell your 2,000 shares, you can be pretty confident that you will get $28.65 for 1,100 of them. But you actually don't know what you'll get for the other 900 that you're selling. Okay, now some brokerages have what are called level 2 quotes that allow you to see not only that 1,100, but how many shares are available at the next best price, and so on, all the way through the whole order book. This is not usually an issue unless you're selling or buying very large amounts. Like, you can do the math there at 1,100 shares at 28.65 is quite a bit of money. So if you're only selling 200-300 shares at a time, this is not going to be an issue. But if you are, for example, implementing an ETF portfolio for the first time, like you have ample savings but you've switched strategies and now you want to implement an ETF portfolio, certainly we've done it with our clients where we're making 6-figure trades. This is something that you want to pay attention to, and I'll show you in a moment how you can ensure that you get a good price or a fair price for your order. Okay, so this kind of leads to our next discussion, which is the types of orders you can place when you buy an ETF. So there are two basic types, a market order and a limit order. A market order says to the exchange, I want to buy or sell at the current ask or bid price, whatever that happens to be. So you could just place a market order for to buy 100 shares of VCN, and you're saying to the exchange, whatever the price happens to be, just fill my order. Okay? The problem with a market order is that the price may be different from the ones in your quote. Okay? Markets can move pretty quickly. And so it's not all that unusual, for example, for you to get a quote and you see it's $25.10, and you do some math to figure out how much you need to buy, and you go to the order screen and you enter it, and you enter a market order, and it gets filled at $25.12 or 13 cents instead of 10. This doesn't mean that you got ripped off, and it doesn't mean that the exchange isn't functioning properly. It just means that markets sometimes move faster than we do, and market orders can lead to a lot of surprises. A limit order, by contrast, says I'm setting a minimum price when I sell or a maximum price when I buy. So that means, for example, you would be putting in an order and specifying the minimum that you will accept as a seller and the maximum that you will pay as a buyer. Okay. When you are using ETFs, please always use limit orders. Don't use market orders. It's one of the more common mistakes I see people make. Limit orders ensure that you're not going to ever be surprised by a stale quote or a market move that happens more quickly than you can anticipate. And we don't like surprises when we're trading, especially if it's large amounts. Okay, so what do you do to set a proper limit order? We have a little memory aid that I like to share. It's just below the bid or above the ask. Okay, so BBAA. It's a good way to remember it. If the limit or if the bid price, for example, is $25.10, you would place your order to sell at $25.08. Okay. If you're going to buy, you might place it at $25.12, so 2 cents above the ask. Now, one of the really important things to understand about this is that placing a limit order does not mean that you will pay more than the current market price. So if the ask is $25.10 and you place a buy order at $25.12, most of the time you're going to get your order filled at $25.10. You're not announcing to the market that you're a chump who is willing to pay 2 cents more than the ETF is actually worth. That's not how an exchange works. An exchange matches buyers and sellers at the best available price. So you're not haggling at a bazaar. All you're doing is setting a maximum price to avoid any sorts of surprises. So this is an important point. I think that a lot of people will say, I don't want to place that limit order above the ask because I'm going to pay too much. It's not true. Once you've placed a lot of trades and looked at the prices that they're filled at compared to the order that you placed, you'll notice that you're getting it usually right on that quoted bid and ask. The limit order is just a safeguard. Okay, so let's have a look at how you would actually do the math to buy your shares and implement your portfolio. So let's go back. Remember in our example, we said our original portfolio was $160,000. We were working towards a goal of $500,000, but we're at $160,000 today. And we were going to add a 20% holding in Canadian equities according to our asset allocation. So 20% of $160,000 is $32,000. So that is the amount that we want to purchase of VCN, our Canadian equity ETF. Okay, so we're going to place a limit order for that ETF, a couple of cents above the ask, and we're going to buy $32,000. But when we do our math, one of the things that we need to keep in mind is that you're going to pay a trading commission on every transaction. So let's assume that the trading commission is $9.95, which is pretty typical for most of the brokerages. So here's how we do the math. Okay, so we start out simply by taking our ask price. It was a few slides ago, but it was $28.67. So we're going to add 2 cents to that above the ask. So 28.69, then we're just going to divide 32,000 by that number. Okay, so $32,000 divided by 28.69 comes out to about 1,115.37 shares. Now we cannot buy 0.37 shares on an exchange, so we always want to round down to the nearest share. So in this case, we want to buy 1,115 shares. Okay. It's very easy to make a mistake when you're doing this on a calculator, so it's always a good idea to double check. So I would suggest you double check by multiplying the price, the limit price, the 28.69, times the number of shares you've calculated. Then you're going to add your $9.95 commission and double check. Turns out this works out to $31,999.30, almost exactly our $32,000 target. So we know we're good. We can go ahead and place the order for that number of shares. So to do that, you just go to the brokerage's order screen. They all look a little bit different. This is just one example. You would select buy, and you would enter the quantity of shares that you calculated. So in this case, 1,115 shares. Enter the ticker symbol of the ETF that you want to buy, VCN in this case. Choose the exchange. All of the ETFs that I've talked about today trade on the TSX, so that's the Canadian exchange, although you can buy ETFs on the US exchanges if you want. But in this case, we're going to select Canadian, and then again, you'll see here you have a choice between the limit or at market, a market order. we're going to select limit, and we're going to enter our limit price, $28.69. Okay, once we've done that, we can ignore the rest of the instructions on the screen there and go ahead and place that order. Okay, then we just go ahead and do that for the other 4 ETFs in the portfolio as well. Okay, and once you've properly planned your portfolio and you've done the math, actually executing the orders should only take you 15-20 minutes tops. It's just a few minutes per order. Once you get experienced, it's really quite simple to do, but it is a little bit tricky at the beginning. And so I want to share a few trading tips for ETF investors, and this goes for both novices and more advanced investors. The first one is, as we talked about a little bit earlier, always be aware of those bid-ask spreads. They can actually be more of a cost than that $9.95 commission you're paying. So try to keep an eye on it. Unfortunately, there isn't really a lot you can do about them. If the bid-ask spread is too high on an ETF consistently, you may want to look for an alternative that's a little bit less costly to transact. But otherwise, there's not a lot you can do except to be aware of it and not to trade too frequently. Another really important consideration is trading volume that does not have a lot to do with ETF liquidity. So what do I mean by that? If you're used to trading small cap stocks, for example, you may encounter stocks that just don't trade very frequently, and you're concerned that if you put in a large order, you might actually move the price, right? So you place a large order to buy a stock that doesn't trade very often, you can actually bump its price up. That is not an issue with ETFs, okay? So many ETFs do not trade very frequently, some of the newer ones and smaller ones. But remember, an ETF holds a basket of underlying stocks or bonds. It's not, and so the supply and demand for the ETF itself does not make a significant difference. What's more important is how frequently traded the underlying securities are. So, for example, if there's an ETF that holds large cap US stocks, the ETF itself might not trade very often, but those large cap US stocks trade very frequently. And so there's a pretty high amount of liquidity in that ETF. And so you don't have to worry too much about ETF trading volume. But just, again, use limit orders and be careful when you place your trades. Another thing to be aware of is you should always trade when the market is open. What I mean by that is I have seen people, for example, place trades at 11 o'clock at night and expect the order to be filled when the market's open the next day. I think it's generally a bad idea. Markets can move a lot overnight. The opening price can be quite different from the previous day's close. So if you're going to be an ETF investor, trade when the markets are open, which is 9:30 a.m. to 4 p.m. Eastern Time. And try to avoid the last few minutes before the market closes and the first few minutes after it opens. Those are times when you're most likely to see pricing anomalies and whatnot in ETF trades. So, just give it 15-20 minutes to get warmed up before you trade first thing in the morning. Don't be in too much of a hurry. Another thing to consider for ETF investors is dividend reinvestment plans, or DRIPs. A lot of people really like these. It is a way of automatically reinvesting the dividends and interest paid on your ETFs rather than having them distributed in cash. You would get some new shares of the ETFs instead. This is a great idea in registered accounts, so RSPs and TFSAs. I tend not to recommend them in taxable accounts because they can be quite an accounting nightmare. If and when you finally sell shares in a taxable account, you need to calculate the correct cost base or book value for your ETF. And if you have multiple dividend reinvestments, you've got to go back and do quite a bit of math to calculate your average cost. Your brokerage might do this for you, but it might not. Certainly, we've seen many, many examples of brokerages doing it incorrectly. And so to make your life a lot easier, I would suggest taking the dividends in cash and just reinvesting that cash once or twice a year. Okay, so the next step is rebalancing your portfolio. We worked really hard to get to a strategic asset mix of 70% stocks and 30% bonds during our plan. But unfortunately, it's not going to stay that way for very long. Your portfolio is always going to stray from its target asset mix as markets move up and down. So in a good year for stocks, you're going to end up with more than 70% stocks in your portfolio. And in a bad year, you're going to end up with less. But over the long term, we want to keep that 70-30 mix pretty consistent. And so rebalancing the portfolio means occasionally selling what's gone up and buying what's gone down. I'll give you a little more specific example in a moment. But this is something that should be done annually is probably enough. With a very large portfolio, you might want to do it by thresholds. And what I mean by that is you can set a limit, say 5 percentage points above or below the long-term target, triggers a rebalance. So if your portfolio should be 30% bonds, you won't rebalance if it's 32 or 28, but if it gets up to 35 or lower than 25, that triggers a rebalance. Another thing you can do is rebalance the portfolio anytime you add a large lump sum of cash. So if you make your RSP contribution all at once, or your TFSA contribution all at once, you'll have a lot of cash that needs to be reinvested. You can use that to rebalance the portfolio at the same time. So I'd suggest anyone who has an ETF portfolio should find or create a rebalancing spreadsheet. You can do it with Excel, or you can find one already online if you're not very handy with Excel yourself. But here's an example. Let's take that $160,000 portfolio that we talked about and assume that we've had a really good year for stocks. They were up about 13 or 14%. The whole portfolio is now $181,872. So it's gained quite a bit. But what you'll see here is that we've strayed from our 70%, 30% target. We're now 73% stocks, and we're only 26% bonds, plus we've got almost 1% sitting in cash because of those dividends that were paid into the account. So I'd say it's time to rebalance this portfolio. And what you can do is set up a spreadsheet that will do the math for you. So it will determine, for example, if our target was 20% Canadian equities, we're now at 21.8%. The spreadsheet will say, in order to get back to 20%, we need to sell $3,284 worth of Canadian equities. And it does the same for each of the other asset classes. And because we're underweight Canadian bonds, it does the opposite. It calculates that we need to buy $6,993 to get back to the 30% target. Now, if you set up your spreadsheet correctly, that last column on the right there will always net out to zero. In other words, all of the sells will be the same value as all of the buys, because wherever you're underweight somewhere, you have to be overweight somewhere else. And sure enough, if you add those 5 red numbers, they will add up to 6,993. So all you need to do is sell the following amounts and then take all of that cash and reinvest it in bonds. And when you do, your portfolio will look like this. Now it's back to balance, 20% targets for those major equity asset classes, 10% emerging markets, 30% bonds. Your portfolio is back to balance. Okay? This is a really important thing, and there's several reasons why rebalancing is so important. The first is, as you probably figured out, it encourages buying low and selling high, which is what everybody says you should do in investing, but which very few people actually do. This is a mathematical way of encouraging you to do that. And so what it does is it imposes a discipline, and it discourages you from being a market timer. So if you've got some money to invest, your question is not, what asset class do I think is going to do well over the next 6 months? It's, which asset class is furthest off my long-term target? That's where I'm going to direct my money. Importantly, rebalancing also keeps your risk at a consistent level. If you did a lot of work and determined that a 70%, 30% portfolio is consistent with your risk comfort level, then you shouldn't be in a portfolio that's 80% stocks or 60% stocks. You should be at 70%. And so rebalancing ensures that your portfolio has a relatively consistent amount of risk at all times. That systematic buying low, selling high may even enhance returns because most of the time you're going to be buying an asset class after it has performed poorly, and if it reverts to the mean and recovers, then over the long term you may find that it enhances returns. It's certainly not guaranteed, and it's not really its main goal, but it is a side benefit sometimes. But one thing you always need to be or keep aware of with rebalancing is that consider costs and taxes. Don't rebalance every month, okay? It's too expensive to do that with all those transaction costs. And if you are rebalancing in a taxable account, remember you're going to be buying things that have recently gone up, and you may be realizing capital gains. So much of the time it's still worth it to do, even if you trigger capital gains, but you don't want to do it too frequently or unnecessarily. Managing your risk is more important than keeping your tax cost to zero, but it is always something to be aware of.